All right. Yo, what's up for everyone on the YouTube replay? In this video, I want to give you an update on my entire stock portfolio because we have not been doing too well. Check this out. On the 1 month time frame, we are down over 10%. Literally just in 1 month, we are down 10%. And to be fair, we do have a lot of tech heavy names like we got Google, Constellation Energy, Meta. These have kind of been struggling lately, but yeah, we have multiple portfolios. We have a Robinhood account and a Roth IRA that I'll get into, a Webull account, a Moomoo portfolio. So yeah, if you like this kind of stuff, make sure to drop a like. I'd greatly appreciate that. But yeah, I love being fully transparent. Let's just get straight into this. So yeah, here's my dividend only account. If you look in the very top left, it's called my dividend only account because every stock in here does pay a dividend. Luckily on the year, we're still up 13%, but yeah, still not a great sign. Not great that we are down nearly 8% year to date. Here's my total equity in every stock. So my largest holdings at the top and then my smallest holdings are at the bottom. And then here's my total percent change on every stock. So luckily we are still green on every stock, but except for Carlisle, we are now red on that stock as of today. So RIP that company. So every stock in here pays a dividend. A lot of these are like dividend growth companies like Google, Meta, Constellation Energy. They have dividend yields of like 0.5%. But the thesis is in like 5 to 10 years from now, my yield on cost is going to be crazy. Like it'll be an equivalent yield of like a 3 or 4% after they raise it so much. Yeah, we just got a $33 dividend from McDonald's as well. So yeah, that's that portfolio. We also have a Roth IRA. A Roth IRA is just a tax-free retirement account. It's not done too well year to date either. It's actually done worse. I'm trying to bring the growth back in here. And actually, I just made some changes. I actually made some major changes to my portfolio. Give me a minute and I'll show you that. Or you'll see the new stock I just bought in here and I want to do some analysis on it. But yeah, we basically started this Roth IRA exactly a year ago and we are down 11% all time in here. But yeah, here are all the stocks that we own in here. Here's my total percent change. And the newest stock I just bought for the first time ever, never previously owned, is actually a REIT, a real estate investment trust. And this is Care Trust CTRE. It's actually a good one. It's a healthcare REIT with like a 3.3% dividend yield. I'll dig into them a little later. But yeah, it's my first REIT in the Roth IRA. And it has a tax advantage as well. But yeah, notably, here's my total percent change. We've done really bad on Webull and CorMedix. Those have really led to a lot of the losses in this portfolio. And we brought back Cavco in here. So if I bet you're wondering, didn't you used to own Moog in here? What happened to Moog? Well, I actually just moved that to my Moomoo portfolio. So yeah, this right here is called my buy and never sell account, where once I buy a stock in here, I never sell it. And we just added Moog in here. I just basically moved my 7 shares over here. I absolutely am in love with this stock. I plan to never sell this one, and I'll do a deep dive on this stock very shortly. But yeah, check this out. This is my Moomoo portfolio. Let me check how we're doing year to date. So even though there's a lot of red out there, this portfolio is really carrying. We are actually return money weighted. We are up 29% year to date. And yeah, look at the NASDAQ. NASDAQ is down 6.6. The S&P is down 4.7, but we're up 29%. It's mainly because we have had some really good performers like Comfort Systems. Even though they're down 5% on the day, I think they're still up like 45% year to date. Powell Industries is up like 60% year to date, or just since January 1st. Coca-Cola Consolidated is up like 40% year to date. Amazon, this one not doing too well, but we've been dollar cost averaging like crazy. If DCA is where you just slowly buy into the stock, it's a more disciplined approach. Like let's say you wanted to own 20 shares of Amazon. Well, don't buy all 20 shares of Amazon today. You know, it's a more disciplined approach. Buy 1 share today and then slowly buy more as potentially the stock price might go lower or higher. No matter what, you just keep on slowly buying. Yeah, Amphenol, that one's been struggling a little bit as well, but this is right where I like to add more shares of this company. Right at their, look at this in the very middle, a 27 forward PE. I think that's very fair for Amphenol and the growth that they have. But yeah, my newest position is Moog right here. And also CTRE Care Trust REIT. Here is my Webull account. This is like known as my risk on portfolio. We have not done too well all time. There's my open profit and loss in kind of the top left there. We're only up 4.69%. And today we're down 1.5%. But here are all my most recent purchases in order. So my newest position has been AppLove and then it was AbbVie. I think AbbVie is one of the best buys right now. It's like a dividend growth stock with like a 3% dividend. But yeah, let's see what's moving the most on the day. So really? Okay, so the only stocks that are green is Progressive, kind of like the defensive insurance stock, and Reddit. Reddit's slightly green after being really oversold. Yeah, yeah, let me just go ahead and show you this. Yeah. Year to date, if you kind of look in the top middle there, we are down 9.5% year to date. Oh, and we have $85 in dividends year to date. I forgot we got a huge. Let me actually pull up the dividends. If anyone likes to see dividends, here's kind of the income. If you look at the very bottom, Progressive, every year they do something called a special dividend. Since they're making so much money right now, they do a special dividend every year. Normally they only pay 40 cents. Notice this is the exact same day. I got 40 cents, and then they paid a surprise special dividend of $54. So I'm like, hey, that's I think my highest ever dividend I've ever got. It's a qualified dividend, completely tax-free too. So I was shocked. Thank you, Progressive stock. That was right around, yeah, right there, a $13.60 dividend when they normally only pay out 10 cents a quarter. So that was kind of cool. But anyway, yeah, here's my portfolio of all the stocks in here. Let me show you my total equity. So my largest holdings at the top here, I got AMD, Futu. I can't believe it. This stock particularly I love. I think is a phenomenal deal. Not financial advice. I got Disney. Now, I will say this is the stock I might give the boot to in an environment like now where the risk to reward, it might start making more sense for me to move my money from Disney into maybe a more total return, better potential name. What do y'all think about that? Because I know a lot of people don't like Disney. The stock's been flat for 10 years. I took a little bit of profit on them while I had the chance. Yeah, the stock is the same price that it was in 2015. It's $99 right now. Yeah, I did sell a little. Yeah, I sold some at $123, $106. But yeah, we bought it at $84. We actually got it at a pretty decent cost basis. But yeah, we're only up 6% all time in here. But let me give you a few analysis real quick on the stocks I just bought. So again, I got Moog now in my Moomoo portfolio, my buy never sell account. I did sell out of MUSA to do that. That was my oil and gas stock. I still love that company, but I might I have some thoughts to give you about that a little later. But let me go deep dive into my newest position, CTRE right here. I really think you'll love this stock. This is Care Trust. It's actually a REIT. I'm down 0.03%, so I'm basically break even on the stock right now. And yo, good to see everyone. Good to see Tommy, Looney, Nick. Sorry if I'm missing your chats here. I want to go over these stocks real quick. Then I'm going to get into all y'all stocks. I really appreciate y'all being here. What's up, y'all? Okay, so yeah, Care Trust REIT right here. This is a real estate investment trust. That means 90% of their assets are real estate. So because they're a REIT, that means they have to, by law, pay out 90% of their taxable income in the form of a dividend. So look at this. They have a 3.5% dividend. That's abnormally high, and that's not abnormal because it's a REIT, and they have to have that. Most REITs have a yield like this, and you can see the payout ratio right there, 85%, which you really don't even look at the EPS for a payout ratio. Here's the PE ratio. Again, you really do a price to AFFO when it's a little lower, which is good news. But look at they do something called triple net leases, and these have insane margins. This is their gross margin, 99% gross margin, net margin of an 83%. So they do triple net leases, and not just for like retail buildings like Walgreens and stuff. They specifically do healthcare properties. Oh yeah, here's some fun facts about this one. Yeah, that you look at the FFO payout ratio, 74% payout ratio, debt to EBITDA. They're one of the most under-leveraged REITs that exist. Oh yeah, and also they're the best performing healthcare REIT by total 10-year return, 11 consecutive years of dividend increases. So let me show you some of their properties. They have like a little list of them, but these are like senior housing care properties right here. I mean, hey, some of these look fancy. Maybe I'll, well, I got a while, but yeah, these are some like, they own like I'm forgetting the names of them now, but some pretty cool like healthcare, senior housing, healthcare properties, hospitals and whatnot. So here's the revenue growth. This is what you want to see. I mean, it's not just some slow, no growing company. I mean, the revenue's up 55, after grew 45. Same with the net income because they're a very high margin play. And this is the best part. I've looked at so many REITs like Realty Income, ADC, PSA, every AMT, all the REITs that exist out there. We just saw this company has a debt to EBITDA ratio of a 0.7. All of them have a debt to EBITDA ratio of like a 5, like 4 to 5. So I'm so impressed. Let's actually pull up their total debt here if we can. Yeah, long-term debt. Look at this. So on the very right there, their total debt is $900 million. Okay, total debt at $900 million, and they have on cash right now. Where's their cash right here? Yeah, cash right here. 200 mil of cash. So anyway, I just really like this company. It's my newest position. REIT, healthcare. And hopefully it'll be a little bit more defensive and growthy. So this one's pretty cool. And then my other position, I got Moog right here, ticker symbol MOG.A. This is an aerospace and defense stock with also a space and data center tailwind. It makes this one pretty interesting. It's my newest position. I bought it today. Well, I previously owned this one, but I just kind of moved it to this portfolio. They're still a little expensive, but let me give you a pitch for this one. On the right, they are at a 29 forward PE. According to my math that I'm doing, they're actually at a forward PE of like a 26, 27. And look at how this is the earnings estimates. Every quarter, this is what the analysts expect. It's the orange line. The blue line is what they actually report. And if they're beating on earnings like this crazy every quarter, and like, look, this is not like, this is real. EBIT right here, they expected 114, they did 142. If they're going to beat on expectations like this, that means the forward PE is actually a bit lower. And here's where the revenue comes from: space and defense, commercial aircraft, industrial, which is their data center cooling pumps and more, and then their military aircraft. They make the guided missiles. They have so many patents, 1,500 patents. And look at this. This is another cool thing. The whole company in the top right is worth $9.4 billion. They actually have a $7 billion backlog, and they're going to fulfill $3.3 billion of it just in the next 12 months. That backlog literally is invaluable. That's so much long-term stability. They're booked out for years. I was doing a lot of research on this company, and look at this. They do pay a dividend too. For dividend investors, you'll love this like me. They pay a 0.5 or 0.4% dividend yield, but look how little the payout ratio is. So they made $78 million this quarter of net income. They made $78 million. That dividend literally on the top there only costs $9 million a quarter. That's why I think they're gonna have a lot of dividend growth in the future. And since they have so much leftover cash, they're doing buybacks right now. They're not diluting you. They're actively buying back their own shares. Pretty cool company. I don't want to spend too much longer on this one, but I could talk about this one for days. But yeah, I really am bullish on this one. They make a lot of spacecraft. They send hardware into space every week. The Voyager spacecraft and a bunch of nearly every man-made like satellite uses their like components and their patents, which is pretty cool. All right, let's look at some of y'all stocks now. Good to see everyone. That was kind of the update I wanted to give on my portfolio. Now let's look at some of y'all stocks. I appreciate everyone being here. What's up, Tommy? CareTrust is a good one. Hey, nice. You bought into that one. And Jeff Mack, shout out the member. He said ZTO. Oh, wait. I thought that was Zoetis. He says ZTO. Let's check out this company right here. And then we'll look at what's up, Mr. Doom and Vin. Monkey D. Luffy. What's up, dude? And Italia, we'll check out y'all's stocks. Okay, so here's ZTO Express right here. Hey, we just started the stream. We're going to be live for another 2 hours, so don't worry. We'll definitely get to every stock here. They're actually a big company. They're an ADR, though. They're worth $19 billion, but they are a Chinese ADR. So let's convert the currency to US dollars. They trade very cheap, like all or most Chinese ADRs. They only trade at 12 times next year's net income, and it's good to see that it's quite lower than the current PE. That means they're actually going to grow their net income. All right. Let's see what they actually do. And this is in US dollars. So here's the revenue. Revenue's up 9.5% year over year. That's a good trend of revenue growth. So revenue's pretty much at a record right now. Let's see the profits. Yeah, wow. So they really are making like 200 to 300 million of real after-tax net income a quarter. Fortress balance sheet. This is a great balance sheet. I mean, man. Oh, look, Alibaba's a big shareholder here. That might add some stability. So Alibaba owns 8.8% of all the shares. What do they do? Plus a 2.6% dividend yield. Let's see. So engages of comprehensive logistics services. It offers express delivery, value-added logistics. So maybe you can help get your packages delivered. Maybe. Oh, is this who Alibaba uses to ship their packages in the? Well, where does the earnings come from? China. Okay, well, anyway, some sort of logistics company. Fundamentals look strong, cheap, multiple. Does Morningstar actually cover this one? They do. Wow. Okay, so check this out. Morningstar has like, what did the bull say? This is updated. E-commerce parcel volume and weight increase faster than expected, boosts revenue growth. A risk of, well, I guess there's the bulls and what the bears say according to Morningstar research. Interesting there. 12 forward PE. PGR gave a fat special dividend. Yeah, dude, Progressive was great. That was great. Scared to open my portfolio. I keep receiving notifications. Yeah, the look on the right here, man. Comfort Systems, I'm down $1,000 just on this stock right here. We're down, look at the very top right, we're down 4% on the day. I love being fully transparent. Look at our Robinhood portfolio. This is rough right here. It's a good day to buy the dip, though, if you have cash. Look at this. New intraday low as we speak. So, yeah, we're down 2.9% right now. I don't believe it, but Constellation Energy is down 10% today. That is just like unbelievable. 10% dip on CEG. That might actually make, yeah, dang. So Carlisle is actually slightly bigger. Jeez. Yeah, here's us year to date, and on the just in 1 month, we're down 10.4% the past month. So yeah, hit the like button to help me out. Oh man. Okay, let's see here. I bought more Microsoft. That's one of the best buys right now is Microsoft. It's such a safe company. They're super cheap. Like I really don't think you can go wrong buying shares of Microsoft right now. They're literally at a 21 forward PE. They own like 27% of OpenAI. Here's some of the news around them. Microsoft and Meta each add nearly 50 billion in data center lease commitments as cloud giants. Wow, this the capex right now is crazy. That's kind of the one thing being questioned on all these big Mag 7 stocks is are they going to get a real return spending all this crazy money on AI? But I think so. I wouldn't get scared out of Microsoft. They're literally only at a 21 forward PE. They're a big software business with Office, Excel, OneDrive, all those software names, and then they're a big cloud business too. Their Azure cloud does over 110 billion of annual revenue, and they literally make in net income like 25 to 30 billion of real after-tax net income every quarter. Plus you get a dividend, they do share buybacks, they invest in the future by investing in their cloud and investing in OpenAI. So I really think Microsoft's a steal of a deal at only 21 forward PE. I mean, I could not see a world where Microsoft's like forward PEs at like an 18 or 19, you know what I mean? So it's a great time to just buy some shares there. Hey, what's up, Marcus? He says Taiwan Semiconductor. I love this stock right here. This is one of my another one that I love. I'd love to own this one. I do not own this one, but I would love to. They are also really inexpensive. Like if you look on the left, you'd think they're really expensive because it says a 31 PE, which means 31 times net income. But this is a growth company, so you really look at a forward multiple and on a forward metric, they only trade at 23 times next year's net income, and now that starts to look really cheap for the number one market share for literally their top two customers is number one Nvidia, number two is Apple. They are the ones that make the chips. They own the fabs. Nvidia, Apple, they just design their chips. Taiwan Semi actually manufactures them, and that's part of Nvidia's moat that they've secured that manufacturing. Taiwan's like rejecting people right now. They wish they could accept them, but like no, they're fully backlogged thanks to Nvidia. But they just print net income and have insane net margins. Look at their net margin, and it's net margin expansion play here, a 48% net margin. So you go spend $100 on one of their 5 nanometer wafer chips, they keep $48 of that after tax. Yeah, literally after tax. So the total revenue was 33 billion, and on that they netted 16 billion. So that's what's insane. Plus you get a great yield of they raised their dividend very fast, way faster than inflation. So you get over 1% of your money back no matter what, and just a qualified dividend every year. A 23 forward PE. I mean, that's really cheap. I can't get much lower than that. I really don't think. So that's why I think like we're kind of close to the bottom, I think. I mean, valuations cannot get much cheaper. Meta's at like a 21. I mean, maybe another 3 to 5% on the S&P at most, but I really think we're very close to the bottom of this whole dip that's happening. So yeah, take a look at the Qs on the day at a new intraday low right now. Year to date down 6.2%. All right, let's look at some more stocks here. What's up? Robinhood account. We could, or should we look at Robinhood stock? That's a good one. What about Neo? Yeah, I'd be real careful around Neo. This is like a Chinese EV car company. Yeah, look at this stock right here. Basically, when they IPO'd in 2018, dang, been flat for 8 years. They just lose a lot of money. I think they just made their first ever profit. So yeah, look at this. This is great news. We definitely want to see them continue this because look in the past. Like this is in US dollars. We've converted it from Chinese because they're a Chinese ADR, but they used to lose like nearly 500 million to a billion a quarter. Well, this quarter, they actually made net income. Are they expected to keep that? Yeah. So next quarter, they're only going to lose 167 million and negative 100 million. So, these EV cars are a low net margin business game. But anyway, yeah, dang, look at that revenue boost. I think they're selling a bunch of like SUVs right now. Oh, look at this. NIO's in-house chip production exceeds 550,000 units. Targets external sales. NIO delivers 80,000th third generation SUV, accounts for 54% of February's deliveries. So yeah, their new SUV must be selling like crazy. And they have like, apparently a good margin. If they're like getting now this close to net income positive from losing 700 mil to a negative 100 mil, that's definitely a great sign. I'd still just be careful with this one. I know there's like BYD's big competition, Tesla. But yeah, they sell EVs. Hey, what's up, Tommy? He said, "Can you do Prim?" Yeah, is that Primross? Yeah. Hey, this is like an HVAC play. An NU, yo, fur. That's a good one. What's up, Travis? Good to see y'all. Whispers. Did you see Amphenol? It's getting cheap. Yeah, we'll look at Amphenol soon. And Vistra, I see VST. Remind me to get to that one, KP. So yeah, here's Primross right here. They've done great since 2019, before COVID, and they're not even crazy expensive. Yeah, on the right, even though they've like had a lot of stock price appreciation, they're only trading at 24 times earnings. 24 times earnings. Oh, they're not a engineering and construction business. So, okay, maintenance, replacement. Okay, so yeah, check this out. So, energy, look at that annual revenue growth. No wonder the stock has done so well. That's impressive. In 2020, it was 1.23. Now in 2025, it was 5 billion. So let's see their other business, the utility side. Yeah, also for the full year 2025 was a new record for them. Let's see their net income. Yeah, they make like 50 to 100 mil in net income a quarter. So, yeah, 24 times earnings. What's a dividend here? Yeah, you get a 0.25% yield, but look at the payout ratio. There's going to be a lot of future dividend growth potentially because only a 6% payout ratio. Hey, OLP Papa, I appreciate you. Thanks for that gift there. He says, I was just thinking about you. Whenever the market crashes, you can trust me to stream. I got you. Yeah, we are down bad today. This, if in the top right, we're down 4% in this portfolio. My Robinhood account is not looking too good. We're down 2.9%. In the past month, we're down 10%. So, yeah, I did make some changes. I actually, well, not really. I just bought some new stuff, one new stock. I bought Care Trust, CTRE for the first time. And I moved Moog to this portfolio over here. So yeah. All right, let's check it out. NU Holdings. This is a great crypto play. So if you don't want to buy Bitcoin, uh, like by itself, you could this stock is like a almost like pseudo crypto play. They're actually a crypto bank out of Brazil, which makes them very unique because people in Brazil, their currency isn't too good. So they actually use crypto for transacting purposes. And NU actually is the main play. 92% of all the revenue comes from Brazil. They actually just applied for their US banking charter. I wonder if we can find that news right there. Um, okay. But anyway, you won't believe the profits they make. And this is real. This isn't like some like one-time adjustment. Like this is really how much net income in US dollars they make every quarter. Just this quarter they made 894 mil. I mean, the year-over-year growth rate is phenomenal. It's up 62, after grew 53, after grew 220. So it's just insane. The revenue was 4.69 billion and they netted 900 mil on that. So that means their net margins are 19%. It's so good. So I just trust this one based off the fundamentals. They literally print net income. It just hits a new record every quarter. So what's it going to be the same time next year? And the multiple is pretty cheap. Partially it's cheap because they're Brazil based, but they're headquartered in the US, but all the revenue comes from Brazil. But the forward PE is a 16. I think that's pretty fair. So yeah, that's NU Bank, NU Holdings, crypto Brazil play. So yeah, Travis, and let me do actually wait, what was it? VST. Yeah, let me do Vistra Energy. Then let's do Amphenol. Yeah, dang, yeah, just like Constellation Energy, Vistra Energy's down 10% on the day. Is there any specific news here? Vistra secures major power purchase agreement from Amazon and Meta. Wow, look at that. Vistra expands generation portfolio. Okay. Oh wait, they upped their credit rating. Wait, what did I say? Vistra receives investment grade credit rating upgrades from Fitch and S&P Global. That's great news. So they're just down bad on the day. Um, I guess I'll look at that article. I guess more than half of the S&P 500 companies are up 100% since Powell became chair. Well, I don't know about today. Well, anyway, what's cool about Vistra Energy is they've been having some weird one-time adjustments. So they had a one-time adjustment to their net income a couple quarters ago or 3 quarters ago. It says they lost 260 million. So anyway, you look at a forward multiple, and according to the numbers, it says Vistra Energy only trades at 17 times forward net income. So that's pretty fair. Only 17 times forward PE. So this is an energy play. Basically, it's an unregulated utility. They sell electricity to like 13 different states through this PJM auction, and the PJM auction prices are really high right now. So Constellation Energy and Vistra Energy are the main PJM plays. Anyway, they're both down bad. It's not just Vistra Energy. Look at CEG in my other portfolio. That stock is down 9% on the day, 9.11%. RIP. So let's check out Amphenol. This is in my Moomoo portfolio, known as my buy never sell account. One of my favorite stocks. Like I kid you not, I love this company, and they're right around the territory where I dollar cost average in at this price. That's where I've been adding more shares to this company because the forward basis is only a 27 forward PE. On the left, they look expensive, 37 PE, but on the right, on the right at a only 27 times next year's earnings. This is a fiber optics and copper cable play. They have two big customers, like Google's TPUs uses Amphenol, and same with NVIDIA's chips, NVLink Spine products. They use their copper cables. And if you go to their main communication solutions, check out the year-over-year growth rates in the middle. It's really impressive. It's up 77 this quarter. Last quarter is up 96, 101, 90. Super impressive growth there. Their next biggest segment, their harsh environment solutions as well. That's also at a record, up 30, after grew 39, after grew 13. So that's on a streak of growth. And then also their interconnect and sensor systems business. That's up 21 after 7. So really good growth on the company. And they have great net income. Like if we just zoom out, this is why I like the stock. Like this year specifically, the net income has shot up like crazy. Same with actually this quarter technically was a record profitable quarter. And they print free cash flow too, like real free cash flow. Like a lot of the Mag 7 have crazy CapEx that's crushing their free cash flow, but they don't have that CapEx. They just keep all their money and it goes straight to free cash flow, and then they do M&A with it. They made $1.5 billion just in free cash flow this quarter, and net income they made $1.2 billion. And if we go to the cash from investing activities, they're always buying new companies. The main way they return money to the shareholder is by doing M&A, which is my favorite part, which is mergers and acquisitions. So yeah, Amphenol is a steal of a deal. I'm still up 80% on them, and now's a price where I'd nibble on them. I wouldn't go crazy, but this is that dollar cost average price where you start to buy just like a small amount. Oh yeah, Jeff Mack, what's up? Good to see you. Yeah, Super Micro. Has anyone heard this news right here? Super Micro places employees on leave after U.S. indicates co-founder and 2 other over alleged China export control. Basically, a few Super Micro employees are like jailed, not just like put on leave. They were actually like arrested. Employees charged in chip smuggling case. There's wow, the news could not get worse. I mean, so basically they're smuggling chips into China. That's just crazy. So on that report, just yesterday, the stock was 27 and now it's $21. What I haven't liked about this stock is the margin issue. Oh, wow. They had a great most recent earnings report. So yeah, look at this revenue right here. This looks great. Like, look, record quarterly revenue. They did 12.7 bill of revenue. And look at the growth rate. It grew 123%. So revenue's up 123, but the net income only grew by 24. Why didn't the net income grow the same as the revenue? Because they're having a margin collapse issue. They have the lowest margin like ever. They used to have like a respectable 7 to 9% net margin. But look at kind of over time, these year-over-year declines don't look great. So I looked into it. They're giving customers like these bulk deals. So it's just not great to see the margins kind of fall this bad. We definitely want to see the recover. Like it's not just look, gross margins, like basic metric here. Gross margins are down 46% year over year after they fell 23, after they fell 17. So that's one thing you do got to watch. I mean, just from the fundamentals, like not even like if that news never happened, the China news, I'd still probably wouldn't buy that stock. Could be a fun little swing trade or something. Hey, what's up, Two Trick? Ooh, what's up? EVPZ said SoFi. I love this company. I am a shareholder of SoFi. Hey, what's up, Isaiah and KP? Good to see y'all. AXTI, yo, should we look at AXTI too? We'll definitely check that one out. One stock I got to cover though is SoFi. I am a shareholder of this one, and I really like this company. I think the valuation is very fair. One thing that sent the stock down a couple of days ago is that there's a short report on SoFi, alleges $312 million in underreported liabilities. I mean, it's not too big of a deal because they make like 200 mil in net income a quarter. SoFi CEO purchases 1 million in company shares. Check that out. SoFi launches SoFi USD stablecoin with MasterCard. Wow. And partners with BitGo. SoFi DIY investor. Okay, well, anyway, what I like about SoFi specifically, and the metric you want to look at is there's financial services on SoFi, because this is what has really led to them going up and beating on quarterly expectations every quarter, because no analyst expected this sort of growth because it really is impressive. Revenue here is up 78%. After grew 85, after grew 114. Like literally every quarter in the middle here, these year-over-year growth rates, like no analyst expected it to be this good after it was so good, I mean, they created this in 2020. The very bottom, the revenue was 2 million, then it was 3 million the next quarter, then 4 million, 6 million, and it's only spiraled higher, 450 million. And then of course they have their main lending business, which is also at a record right now, up 19%, after grew 19. So and let's check out this one, their technology platform. Let's check out all of them. Yeah, also on an annual basis, record 2025 sales grew 19% year over year. That's the highest growth rate on the screen. Look at that. So the growth rate is growing. I really just I really just think they're a good growth stock. That being said, you do not want to make this stock as like a meaningful size position, and you want to be careful dollar cost averaging into them. Like if you wanted SoFi as 5% of your portfolio today, you don't make it 5% today, but you maybe go ahead and make it 1%. Because yeah, here's the quarterly expectations analysts expect. It's the orange line. And notice the past 3 quarters in a row, they beat on revenue. Here's the net income. They beat on net income every quarter. And notice the future projections. It's supposed to go to 195 million of after-tax net income in 2 quarters. So that's why I think people are really starting to take SoFi serious. I mean, I know the stock is on a dip right now, and I'm still up like 150% on the stock. So I'm not looking to add really any more yet, but I really like how the story on this one. All right, so yeah, there's SoFi. I actually regret every share I've ever sold to them. Okay, let's keep going here. What site is this? Yeah, hey, this is a brokerage right here. Very in the link tree in my bio there. It's that very first one. You can get this brokerage I'm on. My favorite one to buy stocks. Hey, what's up, Jose? What's this? Hey, we're just looking at stocks and stuff. Yeah, if you have a stock you may look at, let me know. I'll try and give you some analysis on them. But I see Micron. Yeah, speaking of the memory shortage, I really think Micron's a decent one, but you also can't really trust a lot of money in this one. Let's see, is there any news? They just reported earnings. Micron completes 1.8 billion Taiwan facility acquisition. Yeah, so they need manufacturing capabilities because they manufacture these basically the memory chips, the HD, the SSD, all that. That's basically data centers have sucked up all of them that exist. So the supply can't meet the demand. So there's a huge memory shortage. Micron has benefited like crazy. So this is you trade this off the sentiment of what they're going to do. First off, I can't believe how cheap Micron is on a forward multiple. So if you look on the right there, it says forward PE is a 4.6. So that's what's crazy. Even though this stock has had this crazy stock price appreciation, they're only trading at 4.7 times next year's net income. Is that right? It actually is right. Look at this. Here's what the analysts are forecasting. Literally, this quarter was a record 13.7 billion in net income. Here it is down here. Look, 13.8 billion. It's never even been higher, never even been close before. It was 13 billion this quarter. Well, next quarter, they're expecting 21 billion. And then the quarter after, 25 billion. If you just annualize 25 billion, that's 100 billion of net income a year. And if you look in the top right, the whole company is worth 470 billion. So yeah, they really do only trade at 4.7 times next year's net income. That's why if I was a shareholder in Micron, I actually would not be trimming or selling. I think it's going to go higher. I mean, potentially, if this company just stretches up to like a 7 or an 8 forward PE, that makes you a 40, 50% return, and it still wouldn't be super expensive at a 7 forward PE. Plus, they beat, look at this quarter right here. They expected, so that it might even be cheaper. This quarter, they expected 10 billion. Well, they did 13.8 billion. And that's not some funny money like adjustment. Like, no, this is the before tax. They did 16 billion before tax, 13.8 billion after tax. Incredible. So that's kind of the thing on Micron. But it is really tough to, buy the stock at right now prices. I will say that. Ooh, yeah, let me do OUST. Let me do Ouster, and then we'll do TDUP. What's up, Two Trick? And I'm so behind CEG tanked. I think it's a decent, super small nibble. Yeah, CEG is looking pretty good. And yo, Isaiah, thanks for that huge gift there. No way. Yeah, should we deep dive on CEG? We just did a deep dive on Vistra Energy. They're very similar. Vistra Energy is also down 10% on the day. This is very similar to CEG. I couldn't find any specific news except just the whole market tanking. Let me actually go check on them. Yeah, look, CEG's down 9.5. Yeah, here's full transparency. Look at the top. We're down 10% the past month. Just today, we're down 2.99% RIP. But yeah, Alistair, this is a LiDAR play. And really, this is a play around like a lot of companies are getting into the ride sharing business or, these autonomous driving cars. And these autonomous driving cars are mainly using LiDAR. So yeah, what does this company do? If you look at the top, they say they sell LiDAR sensors. And look at the growth specifically this quarter. I mean, that's what you want to see if you're going to buy and hold a kind of risky stock like this. This is incredible top line growth. Revenue's up 106%, after grew 26, after grew 51. Incredible growth there. Look what they expected. Analysts expected 41 mil. They did 62. And even better, even more incredible, they were expected to lose 22 million in net income and they made 4 million. And like that was an adjustment, like real EBIT, earnings before interest taxes, they actually made 8 million. That's great news. So yeah, I really like Ouster. They still are at the forward PE is a loss, so they don't have a forward PE. But as long as they keep up this top line growth and staying net income positive, I really think this is a good stock, like to have as a really small position. Yeah, I really do like Ouster as a really, really small position. Let's do T-Dup. Yeah, Two Trick. What's up, man? I've never heard of this one. Thread Up. Wow, dang. So they're pretty tiny. If you look in the top right, they're worth 422 million. So 422 million. Yo, dude, James, I really appreciate you, man. I hope you're having a great day. I joined your club. I really appreciate you, James. Yeah, if you got any stocks you want to look at, let me know, dude. I got you. So yeah, teed up right here. Let's see what they do. I don't think I've heard of this company before. Internet retail, online clothing resale platform. Okay, so it's kind of like a I don't know. Here's their website. So it's some sort of like clothing accessories website. Let's see what their revenue is. So the revenue's decent. I mean, 79 mil this quarter. And on that 79 mil, they did lose 5 mil in net income. So that's kind of the tough thing. Like the past year, they've lost 20 million of net income. And that's kind of a big deal when your whole company's worth 422 million. Losing 20 mil is quite a bit. It's like 5% of the whole company. So we definitely want to see them narrow the losses. I mean, just nothing's really blowing me away here, unfortunately. Just because of what the company actually does. Like, I don't know. I'd rather own Amazon. Yeah, I'd rather own Amazon. Um, ooh, let's try WMB. Yeah, Williams. Yeah, this is a natural gas play, actually. And yo, Isaiah, dude, thanks for those gifts there for the freestyle. I appreciate you. So yeah, Williams right here. It's a natural gas play specifically. So yeah. Okay, if we go to their net income, they do print good money. Like this is after tax every quarter. Like before tax, they did 1.26. After tax, they did 700 mil. And they make easily like 700 mil in net income a quarter. And they pay a high dividend. Let's go see how much the dividend cost. So they're making 700 mil a quarter. Ooh, so the dividend cost 610 million a quarter. I'm assuming we don't look at it. Yeah, so actually for this, because this might be an MLP, you really don't even look at net income because you actually got to look at the net income plus the depreciation and the amortization. So you really look at the cash from operations number for a dividend payout ratio. Even still, they can still afford the dividend. Yeah, 2.8% yield. Yeah, so a natural gas play right here. Constellation Energy is a great natural gas play too. CEG right here. Actually, at my house, our natural gas bill is through Constellation Energy. So yeah, let's cover CEG. I appreciate y'all, Isaiah, and who else said that? Yeah, Brian Paul, shout out to member. Let's do Constellation Energy. Yeah, this is a phenomenal buy, never sell stock, I think. If you want an exposure to an unregulated utility, they own 33% of all the U.S.'s nuclear reactors. There is no close second. This is the largest nuclear play. So one thing that is a little weird right now, where basically the what's it called? The DOJ basically forced, because actually, believe it or not, this is the largest energy producer in the US. There's no company right now, after this Calpine acquisition, there's no other company in the US that produces more electricity than them. So actually, the DOJ actually made Constellation Energy sell off $5 billion worth of assets. But good news, all these are natural gas facilities. So what I love is Constellation Energy is the number one nuclear reactor play and the number one geothermal play. They got to keep all the best geothermal assets from Calpine. I just had to sell the natural gas assets. Anyway, let me show you the forward multiple. It's not like they're expensive on the right. CEG is only at a 27 forward PE, and it's not even like they're falling that much. I mean, the stocks, I mean, it's down 10%, but a month ago they were way cheaper at 250. So, and I do think the bottom's really close here. But yeah, I'm a real big fan of this one. They have a dividend. They do share buybacks. Yeah, 0.55% dividend yield. They even said themselves their EPS is going to CAGR over 10% plus through the end of 2030. Yeah, here's a little dividend I got. I own 15 shares. So I'm still up 38%. And there's a dividend I got of $6.40. They should have a lot of dividend growth. What I like about them is most utilities like this have a really high dividend. Think of like Southern Company, NextEra Energy, but not this one. They actually keep and retain a lot of their net income to do share buybacks and do M&A. That's how they just bought Calpine. So anyway, it's not just like CEG's falling. If you look at Vistra Energy as well, which is their other basically, this is the second best kind of nuclear play. They own 5 reactors. I think Constellation Energy owns like 35. I think this company owns like 5 or 6. This is like your second best play. They usually move pretty identically because they're both big PJM exposed. PJM's like this 13 state auction of electricity prices. Okay, my portfolio is 34K and I'm up $500 on the day. No way, agent. Yo, you must have some great defensive names. I think my only green stock is like, look, McDonald's right here. My main man, McDonald's right here, usually is recession resilient, showing its defense today, which is good. But yeah, still, all my other stocks in here are really red on the day. Hey, we just picked up Moog in here, though. We also picked up Cavco and CTRE for the new folks in here. Yeah, check this out. We bought Care Trust for the first time ever. It's my new favorite REIT. We also got a Cavco. Finally decided to get into this. When I moved my Moog position, I just put the funds in Cavco and Care Trust. And I bought a little more Webull. Yeah. Oh, hey, James. Yeah, he says FIX is my fave. Let's do FIX. That's actually my largest holding right here. Dude, James, thanks again for all the gifts there. I do appreciate you. What's your thoughts on Supermicro? Yeah, my thoughts are still I would not buy the dip on Supermicro. But yeah, anyway, let's do Comfort Systems right here. This is my largest holding right here, my best ever performing stock. We bought them exactly, or a little over a year ago was when I first bought my first ever shares. It was actually the DeepSeek moment day. Does anyone remember the DeepSeek moment? That crashed this stock like 18% in one day. I'm like, okay, I finally get to buy the stock. Then it fell a little more, and then it fell more, and it finally bottomed out. So, and then it's just been up ever since. This is a huge tailwind. Actually, I was doing research. 12% of their revenue is actually Amazon, AWS, and their data center expansion. So this company has a huge backlog, a $13 billion backlog. The whole company is worth $47 billion. The forward PE is a 36. That's a great improvement from its current PE of a 46. So 46 to 36, that's great. And they always beat like crazy. And that's using this orange number right here of 3 to 13. Notice every quarter they beat by a huge chunk, not just from some like one-time adjustment. Like, no, they really do beat on EBIT, net income, EPS, revenue. It's insane. And since they have so much leftover net income, they're raising their dividend quarterly right now, which is insane. But yeah, just look at this net income growth. It's like, no wonder the stock has done so well, specifically the past 2 years, because the net income has been on an absolute streak of growth. And it's a margin expansion play. Look at this. Their net margin is up 60%. That's what I can't believe, how their net margin has grown so fast. So anyway, the revenue grew 41. So the revenue, look what that does. When your net margin grows 60%, this is what happens. So they grew their revenue by 41 and their net income grew by 126. Absolutely insane. And they print free cash. Look, so they made 330 mil of net income just this quarter, 330 million, and the dividend just in one quarter cost on the right 21 million. So they have so much future room to raise their dividend. Since they have so much leftover room, they're doing a bunch of share buybacks right now, and they're doing M&A. We go to the cash flow investing activities down here. This quarter they bought, it was this like Florida, this huge Florida like HVAC construction company. So, I forget. I'm not going to remember the name, but I looked into it. It was great. They spent like $200 million buying them. Great new asset. Actually, one of the ways, Comfort Systems, they return 80% of their money ever since 2008. They return 80% of the money in free cash flow they make by doing M&A. Then they do buybacks with another 10 and then dividends with the other 10. So pretty cool company. It's my largest holding for a reason. And even though I'm up 200%, I have never trimmed or sold a single share because I think they're just going to continue to climb higher. Great company. Huge backlog. What's up, him? He says, what's up, brokey? Show your wallet. What's up, dude? Okay. Weeble stock, how many shares of Bull do you have? Yeah, it's still not many shares. This is a stock I never recommend having as a meaningful size position. So I got 101 shares. I'm down 33% on Weeble. FIX is on fire. Yeah, I can't wait till they report their next earnings report. Like right now, stocks are just falling because of sentiments. It's not like Constellation Energy just reported earnings and missed by 10%. Like all we got to do is wait for the next earnings report. And assuming they're going to do good, like fundamentals always outshine in the long run. This is just some short-term war, oil fears. You know what I'm talking about? So it's not scaring me out of the market. I certainly would not be selling or trimming and fully selling out of stocks. I'd be looking to, maybe upgrade positions, like what I was thinking. It's like upgrade a position. Like I have Disney right here. It's kind of like a meh type stock, if you know what I mean. Maybe I can upgrade this by selling all my Disney and maybe buying a more growthy total return stock. Like if I didn't own CEG, I'd probably move it in there or something like that. You know what I'm talking about? Let's see. Dang, the VIX is up by 15. So that's kind of the volatility. Yeah, Super Micro's down 33. Here's kind of some of these are stocks I'd never own. But I guess here's just the watch list. So dang, silver and gold tanked as well on the day, I'm pretty sure. Yeah, exactly. Buy on red. Just sold SEHD to buy Broadcom. Yo, I think that's a good move for the long run, especially if you don't need income right now like me. If you guys didn't know, if you go to my YouTube channel, like my oldest videos, I promise you, I used to only own covered call ETFs and I used to only own REITs. I was that dividend investor. I only wanted high yielding stuff. But then I'm like, this underperforms the market. I just reinvest the dividends anyway. I'm paying higher tax. Why not just do the better growth total return potential stocks? So that's why I like my strategy right now. So here's Broadcom right here. I go for companies that still pay a dividend. I still own dividend companies. That's the main, all like 90% of my stocks pay dividends, but I look for companies with really low dividend payout ratios that leave themselves a ton of money to do share buybacks and still invest in the business via M&A or just reinvest in their own business or do buybacks and buy new companies all without having to dilute the shareholder or issue debt because they just self-fund it. So anyway, here, because the dividend payout ratio isn't eating them. So here's Broadcom right here, a great stock to buy, I think, is a small position. They are about to like literally double their net income. And I think they're potentially might even do better. So if you look at their current valuation, they trade at 60 times net income. But look at next year's numbers. They only trade at 30 times next year's earnings. That's the thing. So net income is literally going to double. So when net income is going to double, there's a lot of future growth happening. And let me show you that. Here's what the analysts are forecasting. The net income is going to go from 4.14 to 11.94. That is an insane net income. And look at this quarter's net income. Like it's never even been close to 12 billion before. And it's going to hit that in 2 quarters. That's what I think. You just wait this out. You just wait for the next, it's kind of this is a buy and never sell stock anyway. You just wait for the next 6 months till they get to this earnings report right here. I bet they'll even blow it out. Google's a big customer. Google's TPUs, Meta's TPUs use Broadcom, Amazon's TPUs use Broadcom. So I really like them, man. They have the VMware software. If we go to their, if we just go to their semiconductor solutions right here, this is their main segment. Hold up. I just realized I'm lagging. Okay, we're good now. Sorry. The kilobytes just went to 0 for 1 second. It just like completely disconnected. I think we're good now. Hopefully that doesn't mess up the stream. Anyway, it might have messed up my screencast. Okay, sorry if it lagged for a second there. There we go, we're back. So yeah, look at their semiconductor solutions right here. Look at the growth rate at the very top this quarter specifically. It grew 52%. After grew 11, after grew 4. So the growth rate is growing. It's out of all the growth rates on the screen, 52% is the highest. And again, it's just projected to go higher via this 29 forward PE. So that's what I really like about Broadcom. They're making the custom chips, helping Google, Meta, Amazon. Pretty cool. All right, let's look at some more here. What are you up all time? Hey, depends on the portfolio. Here's my all-time performance in this portfolio. Well, this is in terms of money, all-time money in there. Let me show you the percentage change though. Yeah, here's this portfolio. Yeah, open profit and loss. See, this is why you don't listen to me. Not financial advice. I'm not an expert. I'm just on here to give my opinion. Can you look at Data Vault and VIV? Oh, Vulcan, dude, good to see you. He says DVLT. What is DVLT? And then we'll look at some of these other names. Hey, Silver, what's up? When we look at MKC, is that McCormick? I think they're doing some sort of deal with Unilever right now, something like that. Anyway, here's Data Vault AI. Dang, yeah, I'd be real careful with this company. Extremely small market cap in the top right. They're only worth $440 million. So do they have revenue? So yeah, here's the tough part. Let's say you buy the company for $400 million. Well, you're buying a company that lost you, 32 million this quarter, 37 million, or call it 40 million. If you lose $40 million, that's 10% of the whole company, 10% of the whole market cap. And they've lost basically 20% of the whole market cap. Do they have revenue though? I guess they do, but it's just so tiny, 2.9 million. So we definitely want to see them narrow the losses and grow the revenue faster. I guess look at that. Oh, wow. Actually, wait, is that right? 2.9 mil of revenue? Huh. Let's see. Where's this company headquartered? They're headquartered in US. Let's go to their website just so I get to maybe get a better idea of what they do. This does not look like a professional website. Looks like a look at that. Why does that look like so stock footed? The same image. Okay. Okay, I just be real careful around this company. They got 66 employees. Yeah, that might be a fun swing trade or something. I don't know about a buy and hold. Let's do Vivo. Yeah, VIVO. Then we'll look at some of these other ones. Yeah, I see INXST. I've been DCing into Grab. Hey, what's up, Louise? We'll look at Grab and Meta. These are good names here. And then I see Iron Mountain. I do own some Iron Mountain. Vivo Power. Yeah, we're not going to cover this one either. If you have another stock, let me know. Because yeah, in the top right, they're only worth 39 million. We just don't really cover the stocks that are worth so little. For the full year 2025, the whole year, they only did 60,000 in revenue and lost 12 million, which is literally like 30% of the market cap. So yeah, don't be so careful with that one. So, Nexstar Media Group. Hey, this is an interesting dividend growth stock. I guess this brokerage is telling me there is a double top, I guess, some sort of a technical analysis formation there. But anyway, if you buy the stock right now, you're getting 3.3% of your money back no matter what, just in a dividend every year. They had a one-time adjustment to their net income, I'm assuming. Yeah, look at this. It says they lost 170 million. Yeah, but they actually made 256 million or around 200 million. So they it says on the left they're at a 76 PE because they lost that net income, but because it was a one-time adjustment, you look at the forward multiple, they're only trading at 9 times forward PE. That's why I think the stock has held up, really good. Actually, the stock's done really good, yeah, despite having a high yield. Nexstar Media Group, let's see what they do. Again, broadcasting. So they do broadcasting, acquisition of Tenga. Maybe they own like news stations. Commitment to local. Today, Nexstar delivers unique, locally produced programming and content to more than 70% of U.S. televisions. They all hours of sports, news, and entertainment programs. All right, so some sort of like, I don't know, broadcasting business. Yeah. Huh. They have a nice yield there, and the forward PE was a 9. So that's real interesting there. Let me do COF real quick. Capital One Financial. Yeah, this is the one that merged with Discovery. Actually, I really like this stock. Another good dividend growth company right here. Let's see. Oh yeah, there were some like charge-offs, high delinquency rates that JP Morgan just said, or I don't know. And plus the state of the private equity market right now is probably sending the stocks, all the financial stocks down, like JP Morgan, American Express, all look pretty similar to that declining stock chart. Let's see if there's any, nope, no AI overview here, but the revenue is going to bump up partially because they merged with Discovery. So yeah, notice the past 3 quarters specifically, they bumped up because they merged with Discovery, and they had a one-time adjustment on that. It says they lost $4 billion. Well, there was a one-time like merger fee, so that didn't matter. So yeah, they really do make. If we go to forecast right here, yeah, next quarter they're gonna make 2.5 billion, 2.63 billion in net income. How much does the dividend cost every quarter? The dividend only cost 580 million. And since they have so much leftover cash, look at the buybacks this quarter specifically. Dang, they did $2.5 billion of share buybacks. They did $1 billion the quarter before. So they're returning money to the shareholder now that the acquisition's over and they're making 2.5 bill plus a quarter. So what's the yield? Yeah, so you get a 1.5% yield as well. American Express is another good one. This is Warren Buffett's second largest holding. All right, so who's this? Or yeah, hey, what's up? Actually, let's do this one first. Louise said, I've been DCAing into Grab. Hey, this one's actually pretty cool. And then we'll look at Meta and Iron Mountain. So what's up, y'all? This is Grab. This is what I like to call international Uber. So they do the exact same thing Uber does, but internationally. So check this out. If we go to market, yeah, look at this. Notice the US and Canada aren't on here. It's Malaysia, Indonesia, Singapore, Philippines, Thailand. And this was a great way for Uber to get international exposure. One of the cool thing is Uber is the largest shareholder at the top here. Uber owns 13% of all the shares. Toyota Motor owns 5.5% of all the shares. They're super profitable now. Like this is real profits here. They used to lose. Used to be a tough buy. They used to lose a couple hundred mil a quarter. Well, now like this quarter, they made 100 mil this quarter. So they really are super profitable now. Let's see what they're forecasting. Yeah, they're supposed to make 80 mil in net income next quarter, 88 million the quarter after. So great growth there. So it's an international Uber play. The commodity of ride sharing is just universally needed. It's probably at a fair multiple here at like a 39 forward PE, just because they're just now getting net income positive. That's why the PE looks so expensive. But I think right now is a really fair price. Probably won't get much cheaper. It still does look slightly expensive at a 39 forward PE, but I really like the business model. I like how Uber backs them. So yeah. International Uber, pretty much. Let's do Meta. Yeah, dude, Meta, such a great company. So Meta, they're in the teen multiples again. I can't believe it. They're at a 19 forward PE. Like the risk reward is so good to just buy shares here. Let's see if there's any news. Yeah, Meta is planning workforce reduction of at least 20%. Meta deploy AI, content moderation. Yeah, Amazon Meta US data center construction to record 45 billion, surpassing office buildings. Wow, that's crazy. Yeah, Meta signs 27 billion AI deal with Nebius to rent out their GPUs. Okay, well anyway, oh yeah, here's some bearish news. Meta delays their avocado AI model launch and considers actually licensing Google Gemini. So maybe bullish Gemini. So basically this company spends so much money. If you go to the cash from investing activities, you're spending like 35, 40 billion a quarter and it's only expected to go up. They're going to be spending like 40 billion a quarter for the next 4 quarters in a row. They're projecting, will they really have good spend on that, especially if they're lagging on their LLM, but I still love all their other businesses. They're saying this will help out they'll get higher margins if they spend this money. They'll get higher margins on their ads because that's the main bulk of the business. And they're now actually introducing ads to WhatsApp and Telegram, or WhatsApp and Threads, I mean, and that'll be a nice little tailwind to the earnings. But yeah, they really do. Here's their basically net income right here. This is before tax net income. They had a one-time adjustment last quarter. Like if you look, it says they made 2.7. They didn't actually, they really made like 20 billion. So anyway, I'm really, really bullish Meta. They literally have 3.54 billion daily active users on one of their apps once a day. I am a shareholder of Meta. Dang, they are not doing too well. But yeah, we're only up 11% all time on them now. We got a little dividend coming in from Meta as well. So yeah, pretty cool. 19 forward PE. I think the risk reward is so fair. It's so fair. Let's see. All right. Iron Mountain. Yeah, let's do Iron Mountain. I freaking love this company. It's a real estate investment trust. A lot of REITs are getting hurt today, just with TLT and how bonds are doing. Where is my Iron Mountain? There it is. It's one of my smaller positions. I got 4 shares of Iron Mountain. They're a good dividend play. If you look in the very middle, you buy the stock right now, you get 3.3% of your money back no matter what, just in a dividend every year. So that's pretty cool. So yeah, they mainly have this like disposal global information business where they like dispose of your like paper and stuff. It actually had the highest growth rate on the screen. Look at this, 9.1% growth. Actually, that's the highest growth rate on the entire screen. So that's great news. And they're also really growing their data center business. They have like 300 million still under construction, a big tailwind still for their data center revenue. But yeah, data center business, it's up 39%. After grew 25, after grew 33. So that's on an incredible streak of growth. And not just their data center, but also their corporate and other. That's up 52% year over year. After grew 69, after grew 62. So really good streak of growth from Iron Mountain. That's how you sustain the dividend. Like out of all the REITs that exist, I want to buy the REIT that's growing their revenue at this kind of rate. Without, and this is all without having to dilute you or issue shares to acquire new assets. It's all just like organic growth. So anyway, pretty cool REIT. It's probably a tough buy here, and one you wouldn't really want as like a meaningful size position. You kind of want as like a small size position, but still a great one. Hey, what's up? Yeah, hey, if y'all are liking the stream, make sure to hit the like. I appreciate that. Yeah. Yeah, TikTok's already, yeah. If you want, if you're still on the TikTok stream, make sure to watch it from YouTube. They already removed my For You page eligibility on TikTok, so RIP. But hey, what's up, Jay? Steele said, what do you think about CEG? I just bought in. Yo, we've analyzed that one a couple of times already. If you give me a little bit, we'll check it out again. Yeah, CEG is a great stock. Dang, what up, Six Star? He says Google is reaching 300. Oh, cool. Wait, once. Oh, sorry. Okay. We're back. Okay, Google right here. Wait, I am unmuted. Okay, cool. Sorry. No, my bad. I had to mute it there for a sec. So here's Google. I do own Google. What is this? Google brings Gemini to Mac in early test. Oh, cool. So Google tests dedicated Gemini AI for Mac to compete with ChatGPT and Claude. Cool. Let me sip my water here. Sorry. Oh yeah, the Google Maps update is pretty cool. I bet you in like a couple years, you're going to be able to like book a Waymo through Google Maps. So anyone that just has the Google Maps app is able to like book their Waymo through there. I think that'll be pretty cool. There's so many businesses Google owns. They own Waymo. They're in quantum chips. Okay, right as I was giving my spiel, they're thinking I'm AFK. Okay. All right, sorry. They said I was AFK. We're back. But yeah, anyway, Google, I love. They own YouTube. They literally own Android in the Google Play Store. They're in quantum chips, TPUs, a huge cloud play. They're a top 10 cybersecurity play with Wiz. Look at the Google Cloud revenue growth rate. This quarter specifically, it grew 47% year over year, after grew 30, after grew 25. So the cloud business is on a streak of growth. So yeah, if we go to their net income, they literally print money and they have a bunch of investments. Like they own 7.5% of SpaceX, which is supposed to IPO at like 1.5 trillion valuation, which is crazy. And a bunch of other investments as well. But yeah, they make like 25 to 35 billion in net income a quarter. That's how they can afford to spend so much on AI, because that's one thing also being questioned. Google spent $52 billion just this quarter on AI chips and cloud infrastructure, which is a lot of money, but they can afford it. They have a 0.3% dividend, and that's not scaring me out of Google. I love this company, and they're not expensive. That's the thing. They're actually cheap. On the right, Google only trades at 25 times next year's earnings. I think that's pretty fair. Only 25 times next year's earnings. I do own Google, by the way. My Robinhood portfolio, they're my largest holding in here. We're still up 83% on them. But yeah, I don't see them getting much cheaper than a 25 forward PE. All right, let's check out some more here. On Neo said CCJ. This is Cameco. This is actually my favorite uranium play. Yeah, this one's pretty cool actually. Hey, what's up, Jeff Mack? We'll do CARR. And what's up, SWAT dude? Happy Friday. Yeah, happy Friday, man. Can you compare Microsoft versus Google? Yeah, we can do that too. We just did our analysis on Google. What'd you think of that? I really do like that stock as a grade never sell. So here's Cameco right here. This is a uranium play. Let's see. Cameco reports 504 million pounds of total mineral resources. Oh, cool. Downgrades Cameco to sell, cuts price target on valuation and nuclear project timeline risks. Huh. Yeah, they are really expensive, but let's see. What are they? The U.S. government deal plants are expected to be online in 8 to 10 years in the future. So that's a bit of a long ways out, 8 to 10 years in the future. I didn't realize that, but let me show you their numbers right here. So uranium segment produced 21 million pounds, surpassing guidance. Pretty cool. Strategic partnerships with Brookfield, Westinghouse, and the U.S. government aim to accelerate reactor deployment. So basically, they have uranium, and uranium is really in demand right now from nuclear reactors. And recently, the administration, we're basically no longer buying Russian uranium. So the demand for these Canadian and U.S. uranium companies have been through the roof because they're in a lot more demand now. So yeah, this is like the best one, but they're really expensive is the unfortunate part. They do make good net income. Like they made 145 mil of net income this quarter. But yeah, look at that forward multiple, only an 85 forward PE. It's just really tough to buy. But yeah, they're a nuclear play. And I like to own the reactors via CEG. This is the one that owns the nuclear reactors. They own 33% of all the US's nuclear reactors, and they're the ones buying their uranium. Another cool one is actually SOLS. So actually, here's kind of the process. They get the raw uranium. The uranium then goes to Solstice right here. And check this out. They enrich the uranium. If you look at the third line here, it says Solstice owns the only uranium conversion operation in the US, which will see higher sales from growing nuclear power. So it goes to Solstice to turn it into that yellow cake uranium for nuclear reactors to actually use. And this is actually one. Let me actually double add this one to my watch list. This is one I might actually add to today or something. Completely forgot about this company. Only had a 25 forward PE now. Look at that, 25 forward PE. Kind of interesting company there too. Hopefully, I just want to introduce y'all to some new stocks. I don't want to just go over Google and stuff, you know. By the way, none of this is financial advice. I sell nothing. I have no course book. Yeah, watch out for people impersonating me. Yo, what's up, MC? Good to see you. Kind of interested in INDI. Yo, OLP, should we check out INDI? Let me know. We can check that one out. Henry says Oracle looks yummy right now. Let's do Oracle. This is like your third biggest, or third or fourth biggest cloud play. So Oracle has the Oracle Cloud, and they have the fourth largest market share, right? A 5% market share. Number one market share is AWS, then Microsoft Azure Cloud, then Google Cloud, then Oracle Cloud. And that is, yeah, 87% of their business. They are the same valuation as a lot of the other cloud companies. Oracle's trading at 24 forward PE. Amazon's at a 24 forward PE. Google's at a 25 forward PE. So the sad thing is, this one's still decent, but I think I'd just rather go with an Amazon and AWS or a Google Cloud, or actually and Microsoft is probably the best one right now. Simply because this one has a really high kind of suffocating dividend payout ratio. Not too much, but they do have a lot of debt. And that has been one huge issue around Oracle right now, is the debt issuance and issuing more debt after they kind of said they weren't going to issue more debt, leading the value to their old bonds to fall to junk bond levels where you could buy Oracle bonds that yield you like 7% on Oracle debt, trading like some junk. But yeah, look at this, 1.4% dividend yield, and the payout ratio is at 40%. So if we go to their net income, you know, they made $3.7 billion this quarter. So they made $3.7 billion, but they have to pay out $1.44 billion in dividends a quarter, which they still have a lot to retain. But anyway, they have a huge backlog, like $200 billion backlog of orders, and I think all that's from OpenAI, which is kind of cool. Let's see, will Morningstar tell us this? Tell us the number? No. But anyway, yeah, there's Oracle. Actually, will they show us the backlog here? Oh, yeah, actually, it's even higher than I thought. Yeah, look at the third line. Retaining performance obligations, which is just contracted backlog, reached $553 billion. It's up 325%, fueled by large AI contracts with new AI-powered companies, basically with OpenAI. That's who gave them the major contract. That's why the stock gapped up this day right here. That the day that backlog was announced, where it jumped up like 300% year over year, the stock went 345, and it's just been down ever since, because basically Oracle has to spend a ton of money to actually recognize that revenue. And so actually some of the orders have been canceled and went to AWS, because look at this, they spent $20 billion just a quarter. They actually have to spend, where are they going to get this money from is the tough thing. They have to spend another like 30-40 billion a quarter for the next 4 quarters in a row, and they have to issue a ton of debt, and it's just kind of a tough scenario. Kind of took longer than I wanted to on Oracle, but all that being said, it's really not too terrible. They the multiple looks fair, but I think I'd rather go with Microsoft here, or even Amazon. Oh, let's see. I've held Meta for about 8 months and I'm net negative. Yeah, hey, that one's a long-term hold. I bet if you wait a little longer, you'll get net positive back one day for sure. So here's Colmaine. Yeah, this is a commodity chicken egg stock. I love covering all these industries, and I actually like this company so much that I decided to buy them. I own 5.7 shares of Colmaine, some boring chicken stock. They literally have a market share, or for chicken eggs, they have a 30% market share for chicken eggs in the USA, and it's mainly a dividend play. You kind of buy them for the yield because they basically have a rule where they pay out 30% of whatever they make every quarter. So last quarter they paid out 72 cents. The quarter before they paid out $1.30. And a quarter before, $2, $3.50. Look, the stock costs $78. So when you get a $3.50 dividend in one quarter, that's like 6% of your money back just instantly in a qualified tax-free dividend. So this is a bet on that one day again, kind of like how oil prices right now, where they just surprisingly go higher. This is kind of just and again, you want to have this as such a small position because it's so commodity related, just like an oil and gas stock. You wouldn't want it as a big size position. You buy this for the commodity news that maybe something happens, the chicken egg supply gets taken off, a bunch of chicken facilities got burned down or whatever, new bird flu issue makes the price of eggs go up. Like we all know the price of eggs were up like crazy a year, 2 years ago. They've normalized now, and that's why the stock is kind of falling a bit. But it's really just a bet on what our chicken egg price is going to do. And another huge cherry on top about this company is, look, they have $1.14 billion of cash and absolutely no debt. So completely debt-free, $1.14 billion of cash, but look at how much the whole company's worth, $3.7 billion. So literally, if you buy the stock right now, 30% of what you're paying is just their net cash on hand. Kind of cool. So, anyway, it's just kind of a chicken commodity bet there. Not one you want as a meaningful size position, but this one. Okay. Happy real new year, everyone. Spring equinox. Oh, hey, I didn't know that was today. Out of all their holdings, what do you consider the safest? Yeah, I said that was a good one. Yeah, McDonald's is a great one. You know, McDonald's, like, they were up on the day. Of course, McDonald's is now slightly red, or they're down 0.02%. But yeah, it's like a defensive stock. I love McDonald's. It's one to just like trust for the long run. It's really a real estate royalty company. In 2008, the stock didn't even dip. They were actually the best performing stock with Walmart in the S&P 500. But yeah, basically, I just like the business model. They're not really a restaurant. They're a real estate and royalty company. Basically, they collect rent and royalties from all the franchises. So if you're a franchise, you don't own the land. You have to pay rent back to McDonald's every month. And 4% of every transaction, every sale goes back to this company, 4% as a royalty, as a sales and marketing royalty. So this company just collects high margin rent and royalties, and they are projected to open up like 30,000 new stores through 2030. And those are just all net new stores that are just going to add new rent and royalties every month. They have a huge real estate portfolio. They have one of the most valuable real estate portfolios in the world, like the McDonald's. Like if you look at like the triangle, the tri-state area, like every location, like McDonald's has the most prime real estate, most valuable real estate in the best locations. So yeah, anyway, great defensive name there with the good dividend. But yeah, that was in terms of safe as in defensive and like the defensive nature of it. But just like I don't know. I own Coca-Cola Consolidated as well. It's like a Coca-Cola bottler. They're down 3% on the day though. But they've had such a great rally before today. All right, let's look at some more stocks here. Yeah, if you got any stocks you want me to look at, let me know before I go here. Let's see. Oh, JVM, good to see you. AVAV, this is a cool one. AVAV, is that Aero Environment? Okay, so let's check it out. The stock, so the stock hasn't done too well. There was some sort of news this day. Let's see if there's any news over here. Weekly news. Aero Environment acquires Empirical Systems Aerospace for $200 million. Wow, so they just bought a company for $200 million. Aero Environment showcases Locust laser weapon system on CBS 60 Minutes for counter drone operations. So we've seen a lot of drone strikes recently. Maybe this is some counter drone thing right here. Well, let's go look at their numbers. And again, maybe this is impacted from an acquisition. Yeah, dang, they've been doing a ton of acquisitions. This is their cash from investing activities. They spent $800 million that one quarter just buying a company. So that might, yeah, so that kind of explains why the stock's revenue has jumped up so much out of nowhere. So it's not organic growth, but it's still growth nonetheless. They just acquired a company to get this sort of revenue growth. They are still losing a little bit of money, but it's not that much. I mean, like 30 mil. We definitely don't like to see them lose this money. Since they lost 160 million, but it sounded like on the news, it said it was a goodwill one-time adjustment. So it didn't actually like hurt their net income. It's a real. So they do autonomous systems and space, cyber, and directed energy. So anyway, some sort of defense name, drone defense name potentially. Yeah, aerospace and defense stock. Maybe we can check out their website right here. AV, yeah, acquires empirical systems. Guess here's kind of what they do. Maybe some of their products and whatnot. Anyway, niche name there. I'd still be careful just because they're not profitable. There's a lot of these kind of stocks out there. They're worth dang $10 billion. That's the same. Dude, they're worth more than Moog. And this company is more impressive in the fundamentals. It's another space and defense stock, military aircraft, data center cooling pumps, commercial spacecraft. They actually look at this one. This one makes like a ton of net income every quarter. I just bought them now. Okay, let's see right there. Yeah, low boring chicken stock. Chicken stock makes for nice soup though. Yes, sir. All right, let's see. Hey, what's up, Miss Rum? Have you ever looked at SEI? And we'll look at INDI as well for OLP. And TMDX, I think that's Transmedics, or we'll check that one out too. So here's Solaris Energy Infrastructure. And then I'll do a portfolio update too, because I know the market's not doing too well. The market closes in 15 minutes or 18 minutes. So we'll check that out. Yeah, not a great Friday. Hopefully we can get a bounce at the last like 15 minutes of the close here. Hopefully some institutional buying will happen. We'll see. But anyway, here's Solaris Energy Infrastructure. Oh, and then I actually have a few stocks I think you might like that I've put on my watch list recently. But yeah, Solaris Energy Infrastructure has done phenomenal the past couple years here. They're down 7% on the day, but they're still expensive at a 60 forward PE, but that's a great improvement from their 92 current PE. Solaris Power Solutions. Look at that year-over-year growth rate. For the full year 2024, it was 38 million. Now it's 333 million. That's insane. Solaris Logistics Solutions. Do we get the quarterly data here? Oh, we do. Look at this quarterly data. Yeah. Revenue was 4 million. Now this quarter, it's 103 million, up 203% year over year. Maybe it's from an acquisition. Dang, they're spending like 200 mil a quarter buying something. Yeah, so that's impressive revenue growth. I mean, as long as I can now see why the stock has done so well. The revenue growth really is at an all-time high record, and I'm assuming so are the profits. Yeah, and so are the profits. Not just the revenue that's at a record, but the profits are at a record as well. So that means the stock price should be, and they are. Interesting. All right, let me check out their website right here. Oh, and you get a dividend of 0.8% dividend yield. So they're an oil and gas equipment and services company. Solaris Energy Structure. Someone said this is in Houston, or this company is maybe. Solaris Energy. Well, anyway, there's their website. These are the industries that they serve. Kind of cool. All right. Yeah, look at that. You're right. Yeah. Hey, look at that in the middle. They're headquartered in Houston, Texas. So, hey, 007, what's up? Yeah, you know your stuff, huh? That's SEI. They're actually on my watch list here. I'll put them back at the top of my watches. They're actually pretty interesting. SEI, selling oil and gas like equipment. Maybe to data centers too right now. Maybe that's what's leading to growth. So AXTI, yeah, let's do AXTI, my Tom. What's up? AXTI, that's that battery company. I think they're like a drone battery company. What's this news here? Okay. Is there any news down here we can get? No news. But anyway, it's kind of the future expectations of what's going to happen with this company. Do we get an earnings overview? Probably not. Yeah. Oh, wait, I'm so dumb. I'm completely thinking of a different company. No. This is the company that has like these materials that go in chips. So they have like the raw substrates, like so they're a semiconductor like substrate play. Like look at this, 76% of the revenue is substrates, and so they got like a big order, and the future expectations are really high. So check this out, revenue is going to go from 17 million to 30 million year over year. So that's a great little increase. Revenue is supposed to nearly double, and even greater. They're supposed to basically lose nothing on that. They lost 7 million on the left, but they're only going to lose 1.5 million. So they're basically potentially in a year, 2 years, going to be making net income every quarter from now on. Ooh, here's where the revenue comes from. This might be something to notice. 56% of the revenue comes from China, then Taiwan, then Europe, And then North America is only 7.6%. So yeah, I guess that makes sense. Taiwan and China using their substrates and stuff. So good balance sheet. Yeah, that's a fortress of a balance sheet too. Anyway, interesting. I don't know if I'd buy it after they've run up so much. They're a $3 billion market cap. That's still, yeah, that's pricey. 33 times sales, but the sales are going to grow. Anyway, it's kind of the stock is pricing in the future growth and they are going to experience some future growth. But after running up so much, any like dent in the story might tank the stock. Let's do TMDX. Hey, and then we'll do VG and EOSE. Yeah, hey, what's up, Catherine and EDO? What's up, y'all? We'll do those for sure. And then the market closes in 12 minutes. So here's Transmedics. Actually, is it the heart and liver company? Yeah, so look at this. Yeah, I actually really like this stock right here. So yeah, look at this. Their liver revenue right here. They treat livers. If we go to the like quarterly revenue growth rate, this is so impressive. It's up 43%, after grew 63, after grew 230. They're on an absolute streak of growth here. Let's see their heart revenue. The heart revenue as well. Let's see it on an annual trend. It's also at a record right now. So, and it's not just revenue growth, because look, the revenue's up. It's 160 million of revenue. On this 160 million of revenue, they kept, actually they had a slight one-time adjustment. They didn't actually make 105 mil, but they did make 22 million. So they really have like incredible net margins now. Because if we zoom out, the net income used to be, they used to lose net income every quarter, but now I should look at the operating profit, but now they really do make some good profits to where the forward PE, whoa. Oh, okay, yeah. They had a one-time adjustment. So it says the current PE is to 23. It's not actually, it's way, way higher because they had a one-time adjustment. But yeah, actually they are a little expensive. A 41 forward PE does make them a little expensive, but they kind of deserve a 41 forward PE. Again, if we go to this liver revenue right here, full year 2021, it was 1.9 mil of revenue. Now it's 460 mil, and these growth rates in the middle are really impressive. So, yeah, interesting name here. Deleveraging the balance sheet. Look at that. The liabilities used to be 71% of the assets. Now it's only 55. Yeah, pretty cool company here. Like a mid cap. Is there any news we get? No. Oh well. Yeah, still pretty good. All right, yeah, let's do VG stock right here. VG, then EOSE we can do, and dark pools at the close. I wish I could listen to your streams in the background. Another one, GPK. Yeah, we'll do GPK too before I go here. And I'll give I'll do a portfolio update too. So here's Venture Global. Is this a natural gas stock maybe? So I guess we'll find out. Yeah, the forward PE implies that a very cheap company actually in terms of what you're paying for, or a net income multiple. They only trade at 12 times next year's net income. So that's pretty fair. So yeah, they have this Plaque Mines project. Basically, it'd be better if I pull up their website right here. So they're in like Louisiana. They have all these, here's their projects right here. LNG projects right here. So it's actually a pretty cool company if you like natural gas. And they're expected to make a bunch of net income. Here's the net income projections from the analyst. Next quarter, they're supposed to make 420 mil. The quarter after, 878 million. So they're going to be making a boatload of real after-tax net income. Let's see. They also pay a dividend of 0.5% dividend. So the payout ratio is only a 7% on that. Yeah, let's see how much the dividend cost. Let's see how much room they have to raise it. Because again, we just saw the analysts project them to make like 800 billion a quarter. Yeah, here's their dividend. Costs 40 to 170 mil a quarter. Anyway, pretty cool company. CEG is a good natural gas play as well. Pinon said, been cooked all year, fam. No money to invest. Yo, I feel you. The market, yeah, since January 1st, yeah, here's me year to date. Year to date, we are down 8.7%. Past month, we're down 11% the past month. Yeah, we're at a new intraday low right now. Let's hope the last 10 minutes can come in clutch. We're down. All right. We'll come back to that later. So here's EOS Energy. They reported earnings and they had a massive gap down. Dang. So they must have had some bad earnings. Let's see what they reported. So yeah, look at that. Dang. Analysts expected 93 million of revenue and they only did 57 mil. So that they gapped down for a reason, and it kind of makes sense when we look at the numbers. They missed on revenue and they missed on net income. They were expected to lose 57 and they lost 250, or basically we can look at EBIT right here, earnings before interest taxes. They're expected to lose 55. Well, they lost 82. So I think that is why they gapped down on earnings. Well, hopefully that context was helpful there. What industry are they in though? Electrical equipment and parts. Offers the first, or well, maybe we can just go to their website right here, EOS. High density energy storage infrastructure. We build resilient grids. Okay. Anyway, some sort of electrical storage company, but I don't like that they missed on earnings right there, but maybe it could be a buy the dip opportunity. We just don't want to see them continue to miss on earnings like that. Oh, wait, someone says, I wish you could watch your live streams in the background. Do you mean on YouTube background? I think you're able to do that. On TikTok, like where you can turn off your phone and still hear the stream. You can do that on TikTok, I know, but there's like 2 different streams on YouTube. You might be able to do it. I don't know on YouTube though. But anyway, yeah, someone said GPK. Yeah, what's up? This is graphic packaging. Dang, the stock is at a new like multi-year low. They're actually the same prices they were back in 2013. So the stock's been flat for 13 years, unfortunately. America's paperboard packaging. So yeah, sounds pretty boring. They just do literally package paper. Sounds like a commodity or something like that. I don't know. Next generation packaging is here. They make the cardboard boxes for companies, or something like that. Yeah. So here's what the first line is: engages in the provision of paper-based packaging solutions for a variety of food, beverage, and other consumer products. So yeah. What's their net margin? Yeah. So look at that net margin collapse. That's not what you want to see. So I'm starting to understand why the stock has done so bad, because the fundamentals aren't looking too well. Here's just the net margin. I can't. Ooh, so look at yeah, that's really rough. So the sales were only up 0.3. So the revenue did grow slightly, 0.3, but the net income, and this was real, not some one-time adjustment, fell by 45%, which again, yeah, it means their net margin fell 58 or 48% year over year. Yeah, it just seems like here's the revenue over time. It hasn't really grown. It's slightly declining. Nothing's really blowing me away here. And it might just be a dividend trap. Yeah, 5% dividend yield. When your net income falls 50% year over year, your payout ratio goes up rapidly. So I actually would not buy that one, or I would just be very careful. Sup, Nathan? Ugly day today for the SPY. Yeah, and it's been a rough day for sure. Definitely a rough Friday. At least we get a buy the dip on nice stocks. I really do think we're close to the bottom. I mean, valuations are so cheap. I mean, just on the Mag 7, like the SPY at worst, like could fall 3 to 5% more, but no, not any more than that. Like I really think like we are close to the bottom. I know there's a lot of fear around oil, war, tariffs, and just there's always bad news, but we just buy and hold for the long run. It's not like these companies are missing like crazy on earnings. It's not like the reason Constellation Energy is down 11% is because they just missed on earnings. Like, no, financials always outshine in the long run. Just wait 6 months until they have their next little earnings reports. Hey, maybe we're having a little end of the day dip. I mean, look at Google. Hey, maybe we'll get the little end of the day 5 minute rally, knock on wood here. Hopefully I don't mess it up, but we'll check it back in 5 minutes and do an update. So yeah. Hey, what's up? Mahale, or I'm probably saying your name wrong, or Miha. What about Transocean? Give me the ticker symbol for that company. We can definitely check it out. You have to turn it on in the settings. Oh, okay. Yeah, give me the ticker symbol for Transocean. Let me do Coremetics really quickly. This is a small... Oh my goodness. Hello? Okay, there we go. I was about to have to Okay. So let me cover Coremetics. This is one of the most interesting small caps, in my opinion. I have full disclosure. I am down 40% on this company. This is definitely not a stock you want to own as a meaningful size position. But let me tell you why this small cap interested me. So if you look in the very top right, the whole company is worth $490 million. So that's a very small company, very small market cap. I normally don't cover these, but here's the thing. Out of all the companies that are worth $490 million, I want to buy the company that did basically 100 million of free cash flow this quarter and 60 million or 50 million in net income. And the revenue growth is insane. Literally, here's the revenue growth. 2 years ago, they had no revenue. The revenue was 800K a quarter. Then they got Deaf and Cath FDA approved and on the market, and the sales have just been up ever since. Yeah, if we go to just oh, it's not going to break it down. Anyway, Deaf and Cath has 80% of their sales. It's just been on a massive streak of growth, and their margins on it are incredible too. They also just acquired, so that they only sell one product, but then just last quarter, if we go to the cash from investing activities, here's a huge move. Again, the whole company's worth 500 million. They bought a company for 300 million, so they bought a huge company according to their market cap. That's why, again, they used to have no debt, but they took on a little bit of debt to do the acquisition. It was so worth it because it diversifies them away from just one product into like 8 different products. So anyway, here's the net income projections. Again, literally, remember the whole company's worth, what was it, 460 million. They're projected to make 43 million next quarter. That's 10% of the whole market cap. And then the quarter after, 32 million. So anyway, I just like that they're making good net income, but again, not one you want to trust as a meaningful size position, a super, super small amount. I'm down 40% on them. What does ticker mean? Oh, that's just like, so for like Apple, that's the name of the company, but Apple's ticker symbol is AAPL. It's like it's the stock like little symbol. That's what a ticker means. All right, let's see. Hood stock. Hey, yeah, let's do Robinhood. I have a Robinhood account and I do own Robinhood stock. This is a great buy. This is a brokerage right here, and they're making a lot of money right now from prediction market contracts. And we actually get the data. If we go to right here, their event contracts traded. This is prediction markets. Literally, and when they created this 9/2025, that month they did 1.7 billion events traded. Just this month in January, they did 3.4 billion event contracts traded. It's insane. One thing that did cause the stock to fall, the one earnings, is their crypto numbers. The crypto revenue did actually fall year over year, the crypto trading volume. So that was one thing analysts weren't, I guess, happy about. But I still love this company, and I'm not selling out of it. Just this quarter, they did 1.28 billion of revenue. And on this 1.28 billion of revenue, they netted 605 million. That's after they paid 50 mil of taxes. They did 605 mil in net income. So that means their net margin is a 47%. So they have insane net margin. Again, they had a one-time adjustment. This quarter says they had a 90% net margin. They didn't actually, so kind of ignore that. But this is real after tax, non-adjusted. Like, this is real, a 47% net margin this quarter. I couldn't be more impressed. They have Robinhood Gold. Here's my Robinhood account. So whenever you go buy a stock on a brokerage, they keep a 0.1% fee. But whenever you go do a prediction market contract, they keep a 2% fee. And so it's literally 20x more valuable to their bottom line. And with the prediction market contracts exploding, their net margins it's kind of simple. So anyway, I'm not a fan of prediction market contracts. I don't recommend you do them. It's pretty much gambling. But who's anyway? Oh yeah, and I think on the Super Bowl. Well, anyway. They're fun to do. Like I put $20 on the Super Bowl to make it more fun to watch. But okay, all right. Let's look at it's RIG. Oh, hey, thanks, RIG stock. Let's check it out. RIG is RIG for Transocean. So this company, dang. So unfortunately, if we zoom out, they're lower than they were in 1997. The stock. Let's see what this company does. But on the 1-year chart, they've done pretty good. They went from $2 to $6. So the chart's done pretty good. Let's see what they do. Oil and gas drilling. They're actually headquartered in Switzerland. So our fleet, explore the fleet. Let's see. So they make oil rigs or something like that. New builds. So maybe they're the ones that literally make the oil rigs or something like that. I don't know. But yeah, they're headquartered in Zug, Switzerland. Offshore contract drilling services for oil and gas wells. It also owns and operates offshore drilling fleets, such as ultra deep water, harsh environment, and midwater rigs. Interesting there. So what are the forward projections here? They're supposed to make next quarter 83 million in net income and then 50 million the quarter after. So they're actually supposed to get net income positive. They've been having some weird adjustments because it's not great to see them lose 1.9 bill in net income. But yeah, actually, that was a one-time adjustment because in terms of operating profit, the core business actually made 240 million. So yeah, look at their profits right here. Actually, they're technically the most profitable like they've ever been. They're technically making like 100, 200 mil a quarter, but like they're seeing, I don't know if it's like a lawsuit payout from like an oil cleanup or I don't know, but they're losing a ton of net income for some weird reason. But analysts are expecting them to make 83 mil, 50 mil the coming quarters. Huh. Maybe with the whole oil price stuff right now, they'll get to drill more. You know what I'm talking about? And make more money. So yeah, US is 42% of revenue. Brazil, Norway. Interesting there. Actually, I mean, they're at a 31 forward PE. Yeah, I can't figure out how to listen to the background on YouTube. I think YouTube makes you have YouTube Premium, which is the sad part. But I'm about to end the stream here, and I know it actually does work on TikTok. I've tested it. You can watch. You don't even have to have anything. You can watch your stream on TikTok and then like close your phone and still listen to it. Um, but yeah. Can you take a look at now? Yeah, hey, what's up, Matt? Good to see you, brother. So NOW Service Now, let's do it. This is a great software name. One of the most quality software names. Like there's Salesforce and ServiceNow. These are like the top dogs in terms of quality. What did I just click here? Anyway, look at this. So they're a subscription model company. Their subscription revenue grew 21% to 3.46 billion. And look at this second line. So they have a contracted backlog. So their contractual backlog increased 25% to 12.85 billion. So we're saying all this like AI is going to hurt them, but no, their backlogged after they fulfilled orders this quarter still grew their total backlog by 25% to 12 billion with large deals and customers ACV over 5 million expanding notably. That's insane. So yeah, that's pretty significant. The whole company's worth 115 billion, 12 billion of backlog. That's like 10% of the market cap. Good news too, they're already net income positive. Here's their after-tax net income a quarter. They really are making like 400 to 500 million of real after-tax net income a quarter, and it's just expected to go higher. It's supposed to go from 385 to 523. EBIT's supposed to go higher too. Revenue, they have one of the best revenue charts. Check this out. I mean, this is why I really like this one. The revenue just hits a new record every year, every single quarter. So the stock is not falling because they're missing on earnings. They're falling because of the whole sentiment around software right now. And it's not just ServiceNow, it's all the software names, believe me. So actually, this is one of the more quality software names that actually I do like to potentially buy the dip on. You wouldn't want to go meaningfully crazy on the dip yet because on a forward metric, they are still a little expensive, but you probably want to look at a PEG ratio or a multiple year out forward PE. But yeah, it says they're at a 46 forward PE or 46 times next year's net income. That's the only unfortunate part that they might still be slightly expensive because I think like Salesforce is at like a 24. I'm actually kind of liking HubSpot right now. It's kind of like a Salesforce competitor as well. Actually, HubSpot looks decent. It's another one that just has, they almost got bought out by Google, but I don't think regulators allowed it. Another one that just has really impressive revenue growth. And they're just now getting net income positive, which is great news as well. They're really focusing on profitability. There's another one you could put on your watch list, still expensive, 90 forward PE on Hub. But yeah, ServiceNow, let's see if there's any news around this company. Weekly news. ServiceNow expands Carahsoft distribution partner. I don't know what that is. ServiceNow CEO announces company maintaining flat headcount levels. Huh. Interesting. Well, there's ServiceNow for you. Maybe we can also check out the Morningstar research, what the bulls and bears say. Bulls say the robust portfolio rapidly propelled to the leadership position with the ITSM. The dominance has enabled it to expand into systems of record for the entire IT function. Well, I won't read all this, but yeah, they deliver excellent profitability and free cash flow generation, allowing them to do acquisitions and share buybacks. Yeah, that's also a thing. They do share buybacks. They don't pay a dividend. I like that they don't pay a dividend. They do M&A and buybacks. Pretty cool. Subscription software name with the backlog. All right. What's this one? Oh, NetEase, NTE. This will probably be like my final one, or if I see one more, we'll do it. But here's NetEase right here. This is a video game stock. They're actually pretty cool. They own Marvel Rivals. Actually, let's see right here. Yeah, and it's had a lot of success overseas because this is a Chinese ADR, but the overseas success of Marvel Rivals and where winds meet may signal the early stages of more sustainable international expansion. And also, App Store fees have just been reduced. Let me pull this up actually. Yeah, look at this. at the bottom or the very middle, Apple reduces App Store commissions to 25% in China. And at the very end, it says expected to boost NetEase operating profit. They said by 2.5%. That's actually a big deal. In Google Play Store fees reduced from 30 to 20%. So regulators are actually forcing Apple and Google to lower their commissions, and it's actually going to help out NetEase's bottom line, as they sell a lot of mobile video games and stuff. But yeah, they trade cheap because they're a Chinese ADR. On the right, they're only got a 13 forward PE, so 13 times next year's net income. But they also have a cloud music business, games and related value-added services. But here's their net income. This is in US dollars too. We've converted it. They really do make over if you average it out, over $1 billion of net income a quarter. And if you buy the stock, you're getting close to 3% of your money back no matter what, just in a qualified dividend every year. Safe payout ratio. Look at how fast they rose the dividend. In 2021, you got 83 cents a year. Now you get $3.12 a year for a $113 stock. Yeah, that really is near a 3% dividend yield. Pretty cool. There you go. And there's a nice little tailwind of the App Store commissions going down. And what other stocks do you think that could benefit? Like maybe just like a boring Spotify. Spotify could benefit from the reduced App Store commissions. Turkish competition authorities fine Spotify. Well, anyway, I want to see if that news is also in here. No, they don't actually have the App Store news on Spotify. Anyway. Oh, you know who that also really benefits? Tencent. Actually, this is the company right here that owns Clash of Clans and Supercell. So have you heard of Supercell? They own Clash of Clans, Clash Royale, Payday, Boom Beach, all the Supercell games. That is owned by Tencent, and that actually should benefit them. Yeah, look at that. Apple cuts store commission rates in China, and they're going to benefit like crazy. Oh, I guess that's actually just in China. The rates are reduced. But still, if they're reduced in the US, that'll benefit them. I don't know if they'll get reduced in the US, but pretty cool. You see IT stocks going down for the next weeks. I don't know. You know, I think just sentiment wise, like I think we really are close to the bottom. Oh, the market closed. Let me see how we did. So yeah, we did pretty bad. We're down 3.08% on the day, but at least the last couple minutes here, it looks like most stocks did have a little bit of a recovery. So that's good news that we didn't just tank more in the close. So yeah, our Roth IRA was down 1.5% on the day. Oh, dang, Care Trust just tanked, especially on the dip right there. Dang. So what? That's weird. We bought them today and I'm already down 4%. Oh, well, good thing I barely bought them. Yeah, Moog fell a little bit too. Dang. So some stocks tanked at the close and some stocks rallied at the close. That's weird. Anyway, yeah, this portfolio was down 4.03% on the day. Pretty crazy. All right, Michael said NMG. Let me know which one you're talking about. Are you talking about Noveo Mondi Graphite? I don't think you're talking about this one. Maybe you're talking about this gold company, or I really don't know. I tried to find the ticker symbol. Both of them are pretty small companies. But yeah, that was pretty much the update. This is my newest position, Moog. We bought them today. I might actually look to buy another share. I can't believe they're down to 291 at this point. This is great. I'm actually happy because we get to buy great companies. Let's see, how did Cavco do on the close? This is our other position we bought today. And then Care Trust, I guess everything interest rate sensitive or maybe just tanked at the close. Huh. NMG, oh, we did find it. NMG, this graphite company. So $300 million graphite company. It's a Canadian stock. Let's convert the currency to US dollars. So they have no revenue. So that's the tough part. When we click on revenue and the revenue estimates, it says 0. And if we go to revenue, it says no data because they've never sold anything. They've never sold a product or a service, but I'm assuming they just own like a graphite lithium mine in development, something like that. So yeah, they're actually headquartered in Canada, Quebec, but they just don't have any revenue yet. That's a tough part. Ooh, so look at this. They have no revenue and they lost $55 million of net income. And whenever you lose $55 million in net income, that money has to come from somewhere. So look at what happened to their balance sheet. It's almost perfect. The liabilities went up by $55 million, or the assets, their cash slightly declined and the liabilities went up by a perfect $55 million. It's unfortunate, but that really leveraged up the balance sheet. And they have no revenue yet. So we really want to see them start to sell at least something. That's why I think the stock has been kind of not doing too well. I bet there's a high short rate. Yeah. Well, actually not that. Actually, it's not high. But yeah, nothing's really blowing me away there. If the US does deploy ground troops, market will likely crash. Yeah. But usually, or almost always, like war fear stuff has always been a buy the dip opportunity. But yeah, it's certainly something that we can't ignore right now. Oil prices, tariffs, just there's a lot of noise right now. Software sell off. You look at JP Morgan. Yeah, we can do JP Morgan real quick. JP Morgan, this is a quality dividend growth stock. If you just buy JP Morgan right now, just boring shares, you're getting no matter what, 2% of your money back a year just in a qualified dividend. So that's very fair. A 2% qualified dividend. They're a big bank. They're too big to fail. They're also an asset manager. And every time they manage the assets, they collect just a high margin fee every year from it. Yeah, here's their after-tax net income right here. It's pretty crazy. They really are making like 13 or 15 billion of after-tax net income a quarter. So they really do make a ridiculous amount of net income. That's how they can easily afford this dividend right here. It's pretty cool. So yeah. And the forward PE, yeah, banks usually trade cheap. Look at this. JP Morgan only trades at a 13 forward PE, a 13 times next year's net income. So pretty fair. You get the good dividend too. Let's see if there's any news right here. Federal Reserve proposes 4.8% capital requirement reduction for largest banks, including JP Morgan. I guess that's bullish. JP Morgan suspends $5 billion debt sale. Yeah, there's been a lot of their charge-off and delinquency rates. There's been a lot of news around the like PE, PC, like private equity, private credit, like a BlackRock right now. I do really like BlackRock actually because of their ETF business. Actually, if you're looking for one of the better names to kind of buy on the dip, JP Morgan's on a dip. BlackRock also has a really high yield. You buy the stock right now, you get 2.2% of your money back plus every year just in a dividend. Let's see if there's any weekly news here. BlackRock launches staked Ethereum trust. Okay, so yeah, this is another cool ETF. So I like their ETF business, and that specifically their Bitcoin. So they own the IBIT ETF and this new Ethereum ETF that actually goes under their alternatives revenue, which is now 12% of the business. Check out the annual growth in 2025 or from 2024 to 2025. That whole business grew 71% year over year as they're collecting high margin fees from their new Bitcoin ETF. And just this quarter, it grew 35%, after grew 45%. So a really good streak of growth. And with these new Ethereum ETFs and stuff, I bet they'll just collect more and more fees off that. But yeah, their main private equity business, they were like limiting withdrawals. They still make good money, like 1.5 to plus bill in net income a quarter. So anyway, yeah, BlackRock's another cool one. I'm just going to keep trench into stocks, I believe, till things turn around like last April. Yeah, it's almost like history repeats itself. It's almost like last April where I just couldn't believe, like, I originally buy the dip and then it just keeps on dipping and the stocks just continue to climb lower. At one point, I was down like $1,000 on Comfort Systems. I was down like, actually I have a screenshot of it. You know what? If we just click on comments right here, because since no one comments on this one, yeah, here's a screenshot. Here's my portfolio a long time ago. Look at the very top. I was down and I didn't even fully max out the position. Look at dang, I was only up 100% on Powell Industries. Amphenol, I was only up 3% on Amphenol. Amazon, we were down 2%. But Comfort Systems, we were down 16%. But here's us today. We're up 270%. Amazon hasn't done much. We're only up 4%. Amphenol's up 80. And Powell Industries is up 550. So they're about to do a stock split, which is pretty cool. But anyway, that wraps up the stream. Let me end this with a quick portfolio update because the market just closed. Here's our Webull portfolio. This is kind of just our risk-on portfolio. Don't listen to me, not financial advice. We haven't done too well. Open profit and loss, we're only up 4.6% all time. We're down 1.6% on the day. Actually, AppLovin. No way. AppLovin's green? Is that like an after hours move? But yeah, actually, not too bad. Yeah, AppLovin is green on the day. Reddit slightly green, and Progressive. It's kind of like a defensive insurance name. But then here are our losers on the day. Futu. I might legit sell all my Disney and go buy Futu or something. Like, I really love this stock right here. AMD's down. Southern Company was down. Sprouts Farmers Market. Iron Mountain fell 5%. The REITs really tanked at the close there. The interest rate sensitive stocks. Let me check TLT. That must have been because of TLT, right? Let me find TLT. Well, let me just type it in because I'm not going to find it. TLT. That must have tanked at the end of the day or something. I mean, not really, or kind of. It is recovering. Actually, that's good. It is recovering. But anyway, that's that portfolio. Then we have our Moomoo account, is known as our buy never sell portfolio. We're down 4% on the day. Comfort Systems, we're down 1,000. Powell, we're down 112, 250 from Coca-Cola Consolidated. And then Moog is our new stock in here. So, and then we have also a Robinhood account. We got two portfolios in here. This is my dividend only portfolio where every stock has to pay a dividend. But most of these are like dividend growth stocks like, Google, Meta, Constellation Energy. They have like low dividend yields, but it's really the yield on cost play. Where in like 10 years from now, my yield on cost will have risen their dividend so much where it's really like on my original investment, I'm getting 2 to 3% or more of my money back just in a qualified dividend every year. And then we also, here's us the past month. We're down 10% the past month. We're down 8% year to date. I think that's right in line with the QQQs though, or let me check. Or no, we're doing worse. The QQQs are down 6% year to date. So we're doing a little worse. And then we also have our Roth IRA, which is just a tax-free retirement account. We started this exactly a year ago. We're down 11%. And these are all the stocks that we own in here. Here's my total percent change. And we got Care Trust as our newest position today. So yeah, that wraps up the stream. See you all soon. Good luck out there. Happy Friday. Don't let the market get to you because fundamentals always outshine in the long run. A lot of these stocks, I bet you will be up like crazy in the future from now, especially if they keep on reporting great earnings reports. So yeah, see y'all soon. Thanks again for being here. Happy Friday. Hit the like button if you haven't already. It would still help out the stream.